All right. We are here in remote locations around the world, bringing you the best information about the TSP on the known planet.
Certainly stuff you're not going to find anywhere else.
I don't know where you're going to find it. I mean, I still try to search around and see if anybody's talking about this kind of stuff. And the only time you ever see anybody talking about it is if it's some financial advisor who's just kind of trying to speak to the TSP, kind of hoping that somebody, you know what I mean? Like they're just trying to get somebody to do a rollover, I guess. I don't know. But it's not like a weekly podcast talking about the TSP. I still haven't found it. If any of you guys watching this know of any other ones, let us know. Put it in the comment section. It'd be great to watch somebody else's take on all of this. But yeah, it's just us, I think.
That's okay. Hopefully we're putting out some good info, and I know some people are like what we're putting out, so we will keep on keeping on. So this week it's another kind of sort of summer doldrum week. It's going to be interesting when things start picking back up, probably after Labor Day. Obviously we didn't get much of a correction this summer. And when that happens, it tends to portend potentially scary October, but we'll see what happens as we go forward. At any rate, 31 August 2025. So we'll take a look at the weekly economic highlights, and something that's always in the Facebook group is should I do a Roth or a traditional TSP? It's not really that complicated. The concept of it, it's just really hard to identify. I mean, it really depends on your personal circumstances and what you think your circumstances are going to be in the future is really what it is. But we'll talk about that. And XLP. So XLP is the Consumer Staples Index divided by the SPY, which is the S&P 500. So basically, consumer staples are the things that people need, as opposed to XLK, which is tech, which people don't really need, they want. So if XLP, what people need, is outperforming the overall market, generally the overall market is going down. So if you look at that ratio, it's really helpful to get an understanding of which way the big trend of the market is going. And then we'll look at the TSP fund direction. Okay. So weekly economic highlights. Again, we've been talking about bonds for a while. This has been kind of a main piece of the administration, or at least the Treasury Department, for quite a while. The idea was that they're trying to sell. They need to roll over. It was something like 25% of the Fed balance sheet by the end of the year. And so rolling over, meaning just like if you were going to roll over your credit card, hopefully you're gonna find another credit card that has a lower interest payment, and you can pay off your one with the other that has a lower interest. And that's exactly what the Treasury is doing. So they're rolling over, and so when they're selling Treasury bonds, that's essentially what they're doing. This week we had a 3-month and a 6-month, but we had other bond auctions also. But the 3-month and 6-month both sold at a better interest rate than they did last week. And the 2-year was kind of a big one because it sold at 3.641 versus 3.92 last week. That's a pretty big drop in the interest rate that the government had to pay for people to buy those bonds. So again, the lower that rate is, the less we're adding to the federal deficit. And 30-year mortgage rates stayed about the same. They rose to 6.69 from 6.68%. But new mortgage applications fell 0.5% after already being down 1.4% last week. So maybe this is the sweet spot for people. I don't know, but there's not a lot of movement at above 6.5% for a mortgage rate. People aren't trying to get new mortgage applications up at anything above 6.5%. And this is where it gets kind of interesting, because if you guys remember last week, the Fed came out last Friday. There was a Jackson Hole symposium. They do it every year. The Fed chairman comes out and does this big speech. And at the end of it, the bottom line is they left the door wide open to do at least 25 basis point rate cut in September. And a lot of it was based on this idea that initial jobless claims had spiked to 234,000 last week. And in the podcast last weekend, we talked about how, yeah, it spiked that 1 week, but that happens all the time because there's some things that happen in the summertime that they're part-time jobs and things like that end at the end of August. And a lot of times this spike number at the end of August will come back down. And that's what happened this year, right? So this week, initial jobless claims was 229 versus 234 last week. So why that matters is that last week's spike, and it was like 225 the week before that. So from 225 to 234 was a pretty big jump. And that was one of the big factors that supposedly led to this expected rate cut in September. Because if initial jobless claims number goes up, it means the economy, is kind of hurting. The unemployment number eventually is going to go up. And so the Fed needs to cut rates to boost employment. But this week we're back down to 229. Okay, so, and then when you go to the next thing, continuing jobless claims, last week was at 1954K, last week is at 1961K, and this week it's down to 1954K. So both of them are saying that the spike last week was kind of a one-off, and maybe the Fed shouldn't take that so much into consideration when they're trying to decide whether or not the job market needs a rate cut. So if we look at the Fed has two sides, right? The employment, full employment, and stable prices. So we're talking about the full employment side. It doesn't look like, from the numbers, that the Fed needs to cut rates to stimulate job growth. The other side of that is inflation. So core PCE came in this Friday. It was up 1/3%. That was in line with analyst expectations, which is great because it means it's not going to be too volatile in the market because the market expected it. But still, it was up 1/3% on a month-over-month basis. That's inflation. That's the Fed's number one inflation gauge. And for the year, it's up 2.6%. So you might think 2.6. The Fed wants the Fed inflation target rate is 2%, and we're at 2.6. That's not that bad. It's not that bad in nominal terms, but it's a lot in percentage terms. And it's been going up for the past 4 months. Last month, on a year-over-year basis, it was 2.6. But every month for the past 4 months before that, it has been going up. So if inflation is going up, right, even if it's just a little bit, or if it's not coming down, if inflation is going up and they're still worried about tariffs, and that'll be like the next slide. But if they're worried about inflation going up, the way you solve for inflation going up is to raise interest rates. If you raise rates, you're pushing down on inflation. You're also impeding on job growth, but that's not the problem right now. So when I look at the numbers, I don't see how the Fed cuts rates in September. That's the bottom line. That's what I'm saying, and I don't see how they do it. Not to say that they won't do it, because they've certainly all but promised that they would. But maybe that's why the market's responding today, Friday, because the numbers are coming out saying, hey, the employment numbers don't need a rate cut, and inflation, if anything, is the problem. So, maybe we shouldn't talk about cutting rates. And at the same time, you got personal income and personal spending both going up this month versus last month. So the overall, in general, people are seemingly doing well. So why do we need a rate cut? And then the last thing that came in on Friday was this de minimis exemption. So they ended, basically, if you buy things on Etsy or Temu or any of the kind of non-big outlet stores, if you order something from China and it costs less than $800, you didn't have to pay a tariff on that. But they ended that as of Friday. So that is going to be kind of interesting to see what happens going forward. So if you order something now from anywhere outside the United States, even if it's something small, you're going to pay the tariff, whatever that is for that country. You're going to pay the tariff on that good that you order. Okay. All right. So we see it in the Facebook group all the time, Roth versus traditional TSP. So if neither one is inherently better than the other, it depends on your circumstances and what you think your circumstances are going to be in the future. So if you elect to do a Roth TSP, you're going to pay the tax before you contribute every payday. So your salary comes in, you pay taxes on everything across the board, and then with after-tax money, you're contributing to your Roth. So that means whatever contribution you're giving to TSP, whatever investment you're investing in TSP, decreases what you could have had as take-home pay, right? You're also contributing less because you're paying taxes on the front end. So there's less money going into your TSP account, so you have less that's going to compound over time, right? So if you're in a Roth TSP, you should expect, your total if you're investing in TSP for 30 years versus somebody who's using a traditional TSP and invests for 30 years, all things being equal, your bucket at the end is going to be less if you have a Roth TSP than it would be if you had a traditional TSP, right? But when you go to withdraw it, you don't pay any taxes. And if you're in a traditional TSP, you do pay taxes on the withdrawal at your tax rate at the time. So if you don't want to worry about having to pay taxes when you withdraw, a Roth is the way to go. And so what that comes down to is what you think your tax rate is going to be when you go to withdraw, which is very difficult to figure out. In fact, you really can't figure it out, but that's the thing that you have to think through when you're just coming into government service and you're trying to decide, do I want a Roth TSP or a traditional? And you could do one of both, one of each. But if you go with the traditional, you're not paying taxes when you contribute. So it's before taxes is the money that goes in. So that means either you're going to have more to contribute, right? Or you're going to have more in take-home pay. Either way, you're going to have more to work with because you're not paying taxes before you contribute, which is good. So if you contribute more, you're going to have more in TSP at the end of the day. But you're going to get taxed at your personal rate when you go to withdraw it. So the question is, do you expect taxes in general to go up over the course of your career? And do you expect your personal tax rate to go up? Because if you're going to get out of government service when you retire and then you're going to go get a W-2 job, some consulting company or whatever, if you're going to have a lot of W-2 income, you're going to be in a really high tax bracket. So you would be, in that case, you would be better off having done a Roth, because when you go to withdraw the money, you're not going to pay taxes regardless of your tax bracket. But if you are in a low tax bracket, right, then maybe you would have been better off doing traditional, because that's going to make the account grow faster. So those are the things you kind of have to think through. It's not very complicated. It's just that there is absolutely no one size fits all.
Yeah, so I'm going to throw a wrench in there. I don't know if you're going to talk about this, Jerry, but in 2026, they're going to add one more little flavor where we can actually now do Roth conversions in the TSP. And so that's a good thing, by the way. Like, you want to be able to do Roth conversions before 2026. Historically, we haven't been able to do that in a TSP. You would have to do a rollover and then do the conversion. And so I think this is a great thing. It's not talked about a lot right now. We actually should do a little deeper dive into it on another podcast, because I like the idea of Roth conversions. Now, you have to prepare for them. And as far as I understand the new rules for 2026, you have to use external money. So this is how a Roth conversion works if people don't know what I'm talking about. So if you have a traditional IRA or traditional TSP, 401k, whatever. So you've done pre-tax, right? You put the money in there. Like Jerry said, one of the great things about that is you're putting more in, so it allows you to compound. Now, later on, when you've got a huge bucket of money in your account and you're contributing little compared to that, it's not as big as impact, but definitely early stages. So that's how some people kind of approach it. But let me get back to the Roth conversion. So why this is kind of important is it allows you at various times to convert all or part of your traditional account to a Roth. So the way that works is you pay taxes in that year that you do the conversion. And so if you find yourself in a year that for whatever reason you're in a lower tax bracket that year, that's a good time to do it. Now, one of the things that's kind of an ouchie is you got to have external funds to pay those taxes. You can't use the funds that you're converting, right? So if you're converting $500,000 and you say to yourself, "Oh, I'll just take it out of the conversion," you can't do that in the TSP. As far as I understand so far, that's not allowed. So you do have to have that chunk of change. And so what a lot of people do, and this is really, before I forget to say this, the reason why I'm bringing this up is all of this, as Jerry said, all of this has mostly to do with your tax situation. So if you don't have a good CPA who understands this stuff, or a good financial planner who understands this stuff, you're doing yourself a disservice. You've got to get one, because they'll tell you when. Because you can make a lot of assumptions. Like Jerry said, you definitely don't know what the tax rates are going to be. We don't control that, right? So if taxes go up, they go up. If they go down, they go down. We don't really control that. Our personal tax rate, we kind of control that. But you have to know what your situation is going to look like. So you got to make a lot of assumptions of what your world might look like in 20 years. As you get closer to retirement, you may know what that looks like. But you probably don't if you're 20 years out from retirement or 30 years out. But you can make assumptions, and that helps you decide along the way. There's a lot of cool things about the Roth conversion, and again, I think we should probably do this on a deeper dive on another podcast. I'm actually looking at writing a blog article, so you guys keep a lookout for that on our website. I was going to do one for kind of both, like what Jerry covered, which is kind of the, either or. What's the difference? And then this whole Roth conversion thing really deserves its own topic, because it can be a very strategic way to, at times. So there's some good examples, and I won't get into them here, like for military members who may get a lot of tax-free income being deployed or whatever that year, and converting that and things. So there's a lot of things that can come into play where you might be able to take advantage in a given year, roll some of that over. I shouldn't say roll, but convert some of that over to a Roth. And now what you have is it's the taxes are paid. Right? They're done. So now when you start taking out, what the other good thing about, I just want to mention this, you don't have RMDs. I forgot what that stands for. Jerry, help me out.
Required minimum distribution.
Yes. Distributions. That's the only part I could remember. With the traditional, you have to start taking money out. Right. And what if you don't want to? Maybe part of your plan is to give some of this away to your kids or whatever. And so but you're forced to start taking it. In a Roth, after you've done this conversion, you're not. And there are ways. Again, all of this is something you need to talk to a financial planner or a CPA. Jerry and I are neither, right? But you need to get educated on this stuff, because you can do some very interesting things that's helpful to your tax situation by knowing all of this, or at least finding someone that does. So I'll stop there, and I won't keep kicking around the Roth conversion, but you definitely should kind of look at that. And I think it's exciting that next year we're going to be able to do that in the TSP. So it's a pretty cool deal. Yeah.
I think a lot of things are going to change, to be honest. And I don't know that all of them are good. I like the idea of a Roth conversion in TSP. There was something that just got signed that enables 401ks. It didn't say anything about TSP, but I imagine TSP is going to get thrown into the mix. But it's talking about 401ks having access to private equity and private credit and some like pre-IPOs and all that,
The problem with most of it, though, as I'm sure you know, and we could probably talk about that again. This could be a whole podcast just talking about that little thing when that popped up on the radar. But when you dig a little deeper, what they're calling private equity and private credit and all that is wrapped in these things that make it safe for you. So you're not really getting direct access like you would. And I don't know that is safe, to be honest with you. Like, I'm always on the border, I'm on the fence when it comes to Are these things really protecting us, or are they just, they think we're stupid and we don't know what we're doing? Well, some of it is that. Like, if you're not educated in how to do this, you can mess yourself up really quickly. I mean, you can put yourself in very risky situations most of the times with private equity. One of the biggest key things with it, private equity and anything on the private side is that's not very liquid, right? It locks your money up because they're using it.
Yep.
Right. They're using it to invest in things you can't invest in. And so you give them 50 grand or 100 grand or whatever it is to buy into it. And it's theirs for the next 5 or 10 years. And you just got to wait it out. And so that's not something most people are capable of doing,
You had to be, I think as it still is right now, you have to be an accredited investor, what's called an accredited investor. To have access to some of these different investment vehicles. And what they're basically doing is given the industry access to people that are not accredited investors. And maybe they batch it in a way that protects us a little bit, but I would be very skeptical of it at first. I think,
it's just like giving you access to crypto 10 years ago. Bad idea. Right now, getting access to it because there's a lot of guardrails that have been put in, and it's starting to get more. So it's not quite as it's a lot more stable of an asset than it was for the average retail investor. These are kind of going to be the same. You got to wait it out and see what happens, and at the end of the day, I'm not sure it's going to make that drastic a difference in a given TSP fund. I think, doing what we talk about, just actually paying attention to your account and not putting in there and never looking at it again. That one thing, just actively managing your account, will make such a difference than all this other stuff,
Yeah. Very true. Very true. All right. Let me see what we got. So if you're only looking at a handful of things every week, this is a good one. It's really one of the most important ratios you can look at. So this is a chart of XLP divided by SPY. So XLP is consumer staples, right? It's things that people buy because whether we're in a recession or a depression or the market's doing well, right? The economy's doing well. There are things that you need, toilet paper, all that kind of stuff. That's the XLP, consumer staples. When you divide that by SPY, which is the whole S&P 500 index, which, as we know, is dominated by big tech, right? It's really dominated by 7 companies, but it's completely dominated by big tech. So when consumer staples outperforms the overall index, it means the index is probably going down, right? Because people are leaving tech and they're going into consumer staples. So what I did here was this candlestick chart is a chart of the ratio. And the red chart down here is the S&P 500. Okay. So here, let's just start here at the bottom from COVID. So when COVID started, getting going, people were leaving tech and risk on assets and rotating, because most big investors, you can't just sell it and go to cash. You have to rotate it into something else. So they're rotating it into less risky things like consumer staples. And so that's why the ratio of consumer staples versus the overall market goes up when the S&P 500 goes down. Okay. And then when the ratio comes down, the S&P 500 rallies. So one of the good, very useful ways of looking at it is if the ratio starts falling, right, and the S&P is still falling, the S&P is getting ready to bottom, right? That's one, for an example, one really good way to use it. So right here, going into 2022, you got the S&P moving higher, right, all the way into the beginning of 2022. But the ratio started to turn up before the S&P rolled over. So the ratio turning up, it's telling you more money is going into consumer staples, right? It was a big red flag for the overall index to roll over. Okay. So where we are today, we put in a low in the ratio. right? And once we put in that low, the ratio moved higher. That's when the market's coming down, right? The peak, we're at a peak in the end of 24 was a low in the ratio. When the ratio starts moving up, the S&P is moving down. The ratio peaks, starts moving down. When the ratio is coming down, the S&P is going up, right? So we are looking at this low, and this week we blew through the double bottom possibility, right? It's possible that we could have had a double bottom here, and the ratios start moving higher, and when that happens, the index moves down. But it looks like, depending on how Friday closes, because this is a weekly chart, if we close down here way below the prior low, it's very likely that the ratio continues down and the index continues up. And the other valuable part of that is if you get a pullback, right? So we know that right here is going to be some kind of resistance. So if the ratio continues down, comes back up and hits that, what should be resistance at that point, and then rolls over, it's likely continuing lower. So we might get something like this, right? It's just, the ratio of XLP to SPY is a really valuable overlay for the index itself, and can confirm, either confirm the movement of the index or make you kind of look at it and go, it doesn't look like it should be going in that direction. Okay, so the TSP fund direction in general, we put this up last week. This is the S&P 500 RC fund. It's a weekly chart. So each one of these ticks is 1 week of price movement. If it's green, it means the price closed for the week higher than where it opened. If it's red, it means price closed the week lower than where it opened. This is a 50-week moving average line, that black line. And so what you can see is every time price gets down to it, it tends to find support there, right? And in a bull market, it finds support there and keeps moving higher. In a bear market, it hits resistance there and keeps moving lower. So it acts as both support and resistance, which is pretty valuable. So we are pretty well above that 50-week moving average line. We're above the prior high, and everything looks good, right? The direction obviously is up and to the right. So the question is, okay, we're up and to the right. How high can we expect to go? Or is there any kind of guide or anything to suggest that the market might roll over anytime soon? One kind of good tool you can use is what's called a Fibonacci extension. So if you do an extension of these big moves, so this was the top in 2018, this is the bottom in 2018, and if you use this Fibonacci extension tool, 1.618 times the distance of this move down gets you to this level. And in this case, you can see it pretty much hit it. That's where price got to right before COVID, and then it rolled over. So if you say, okay, what about if I apply the same tool to the COVID collapse? So here was the peak, here was the bottom from COVID, and this would be my 1618 target. So price hit that target, pulled back, got a little bit higher ultimately, and then rolled over into 2022. Okay, what if we look at 2022? Because that was a 20+% move to the downside. Here was the top, here was the bottom. This was the target, and we pretty much hit it. We're just slightly above it, and then we had that big move down in April. And so if we say that big move down in April is good enough, what's the 1618 from there? We're up here at about 71.57. So if you're just using this one tool, Fibonacci extensions, just to the 1618 level, we still have a ways to go to the upside on a weekly basis. Doesn't mean it can't roll over. It doesn't mean it's going to go up there in a straight line. But the 1618 is a pretty useful tool to try to anticipate where we're going on the upside.
Yeah, I think it's key to remember that, the not going in the straight line. Can you go back to that just for a second?
Yep.
Because I don't want to just kind of fly past that. We we accept that, like people like you and I, because we know exactly what you're talking about. But just think about that for a second. If you're trying to learn you're trying to learn how to use the tools Jerry just gave you, which are incredible, simple thing to just figure out the direction potentially for the market to go, because these work. You just saw Jerry just pointed out several times. So these work. It's fact. It's not just opinion. But you can also see where there's lots of up and down. If you can, Jerry, go back to the other ones that you show the little zigzags along the way where it eventually got there to that level. But there's some ups and downs, and this is weekly. So there's some significant drops in those weekly time frames that you would have to stomach, even if you accept that it's going to go to that higher level. So I just want to kind of like hone in on that for a minute, because I know a lot of people miss that part, right? Because they're just like, oh my gosh, it was supposed to go up, and it's like it's down 3% this week, and okay, well, zoom out, right? Take a deep breath, zoom out, and look at it and go, oh, okay, well, in the big picture, that's just a little zigzag, right? That's just a little up and down. Now, if it keeps crashing, that's okay. Well, then that's a different thing, right? If it's going on for weeks. But you have to be willing to accept that stuff if you're going to follow the trend and you're going for the long-term trend. So that is an awesome chart, as long as you remember the little details that Jerry said, right? Where you don't know that it's going to go there. It absolutely can do something else. But let's just say that there's a high probability that it will, but it's not going to go in a straight line.
Sure. A great example of that is the summer correction in 2023, right? This was at least a 10% correction, and it was on the way, right, before we even got back up to the prior high. Right? This was a huge move to the downside, and it could have kept going down, right? These aren't. It's not. And what you said, I thought was kind of interesting, because I think people could look at this and say the market is supposed to do something. The market's never supposed to do anything. All we're doing is overlaying tools that have historically worked. There's no guarantee that price gets up here, right? It's just that over the past, we did it since here 2019. We took the major declines and we applied the Fibonacci extension tool. But it's not. There's no guarantees that it's going to happen. It's just it's a guide.
Yep, and it's a good guide. I mean, it's a really good guide to give you the probability, because if you didn't have that, you'd just be completely guessing. You wouldn't have any I mean, just using the 50 month. That's the 50 month, right? Or 50 week. I'm sorry.
50 week, yeah. I tell you what I like to use it for. 50 week. What I like to use it for is when price starts getting up towards that target, then my bias goes from being very bullish to kind of 50-50, right?
That's exactly what I was going to say next. Because your risk, the closer you get to, I'm going to bring it back, the closer you get to that sort of, potential resistance level, right? Because that's what that is when it hits that, that top line up there, the 1618, that's what, so you want to get really, really skittish right about then. And I would say there's nothing wrong with, a lot of times what people will do is pull 50% off the table, right? And just wait and see what happens. And that way you're not all in, take some chips off the table. There's nothing wrong with that. That's just called preserving, right? A lot of ways to play this game. If you like the way we play it, then pay more attention to the podcast. If you really like what we're doing, you can go check out our website, growmytsp.com. I'll put that up there. You want deeper dive into all the funds? We do it every week in our analysis and the weekly newsletter. And we actually have models that we follow, our customers follow. And if you have any questions, make sure to put them in the comment section. If there's no comment section, just shoot us an email at support@growmytsp.com. Hope you guys have a great week, and we will see you later.
See you next week.